Legal Principles of Insurance Contracts. Chapter Objectives. Dear learners, at the completion of this chapter you should be able to explain principles of insurable interest, understand principles of indemnity, describe principles of subrogation, understand principles of utmost good faith, describe principles of contribution, understand doctrine of proximate cause. Introduction. Insurance is effected by legal agreements known as contracts or policies. A contract, contrary to the impressions of many, cannot be complete by itself, but must be interpreted in light of the legal and social environment of the society in which it is made. Dear learners, this chapter discusses the basic principles that underline the insurance contracts. The most important fundamental principles of insurance contracts are: 1. Principles of insurable interest. 2. Principles of indemnity. 3. Principles of subrogation. 4. Principles of utmost good faith. 5. Principles of contribution. 6. Doctrine of proximate cause. 2.2 Principle of insurable interest. A fundamental legal principle underlying all insurance contracts is insurable interest. Under this principle, an insured must demonstrate a personal loss or the insured will be unable to collect amounts due when a loss due to the insured peril occurs. Insurable interest is always a legal requirement because to hold otherwise would mean that an insured could collect without personal loss. When we say that a businessman has an interest in several companies, we usually imply that he has more than mere mental attraction towards them. This is also the sense in which the term is used in insurable interest. The essentials of insurable interest are as follows: I. Presence of subject matter to be insured. E. Existence of monetary relationship between the subject matter and their would-be policyholder. 3. The relationship existing between the policyholder and the subject matter need to be legal. IV. The policyholder must be economically benefited by the survival or suffer an economic loss from the damage or destruction of the subject matter. An insurable interest may be applied on life, property, or potential liability. Life. I. Self-insurance. An individual has an insurable interest in his own life, and there is no limit to the sum for which a man may insure his own life. In practice, the sum insured is restricted by the insured's ability to pay premium. E. Husband and wife. A wife may insure the life of her husband because his continued existence is valuable to her and she would suffer a financial loss upon his death. Likewise, a husband may insure the life of his wife because her continued existence is valuable to him and he could suffer a financial loss upon her death. 3. Creditors and debtors. A creditor stands to loss if his debtor dies without paying the debt. Thus, he has the right to insure the debtor up to the amount of the loan. IV. Partners. The death of a partner could well cause financial loss to the survivors, who, therefore, have a right to insure him. This could arise with a professional firm or perhaps with theatrical performers. The amount of insurable interest would be difficult to ascertain, but legally it is limited to the financial involvement in the person insured. A father may insure the life of a minor child, but a brother may not ordinarily insure the life of his sister. In the latter case there would not usually be a financial loss to the brother upon the death of his sister, but in the former case the father would suffer financial loss upon the death of his child. Property. Insurable interest in property may arise as follows. I. Ownership. This is the most obvious form, and in addition to full ownership, part or joint ownership gives the right to insure. With part ownership, the insurable interest is strictly limited to the financial involvement, but a part owner may insure the property for the full value, as he will be deemed to be acting as an agent for the other co-owners. Any amount he receives from the insurance, over and above his own interest, is to be held in trust for the co-owners. E. Husband and wife. A husband has an insurable interest in his wife's property as he is legally entitled to share her enjoyment of it, and a wife similarly has an insurable interest in her husband's property as their relationship is reciprocal. 3. Administrators, executors and trustees. These are all persons entrusted with the estate and affairs of others. They have a right to insure the property for which they are responsible. IV. Bails. These are persons or entities legally in possession of goods belonging to others. For example, laundries, cobblers, and the like have the right to insure for losses to goods in their custody representing interest of the owner. V. Agents. Provided the principal possesses an insurable interest, an agent may effect an insurance on his behalf. The insurance must, however, be authorized or ratified by the principal. A householder may effect a policy, which extends to cover the belongings of members of his family. Another example is with a private car insurance, which normally extends to cover the liability of other drivers using the vehicle with the insured's permission. V. Mortgages and mortgagors. The interest of the mortgagee is limited to the sum of money that he has advanced. Liability. Insurance of liability seldom gives rise to any difficulty over the existence of insurable interest. A person clearly has an interest in the sums he may be called upon to pay to third parties as a result of accident, when the insurable interest must exist. In property and liability insurance, it is possible to effect coverage on property in which the insured does not have an insurable interest at the time the policy is written, but in which such an interest is expected in the future. In marine insurance, a shipper often obtains coverage on the cargo it has not yet purchased in the anticipation of buying cargo for the return trip. As a result, the courts generally hold that in property insurance, insurable interest need exist only at the time of the loss, and not at the inception of the policy. On the other hand, in life insurance, it is the general rule that insurable interest must exist at the inception of the policy, but it is not necessary at the time of the loss. The courts view life insurance as an investment contract. To illustrate, assume that a wife who owns a life insurance policy on her husband later obtains a divorce. If she continues to maintain the insurance by paying the premiums, she may collect on the subsequent death of her former husband, even though she is remarried and suffers no particular financial loss upon his death. It is sufficient that she had an insurable interest when the policy was first issued. 2.3. Principle of indemnity. The principle of indemnity states that a person may not collect more than the actual loss in the event of damage caused by an insured peril. Thus, while a person may have purchased coverage in excess of the value of the property, that person cannot make a profit by collecting more than the actual loss if the property is destroyed. Many insurance practices result from this important principle. Only contracts in property and liability insurance are subject to this principle. Life and most health insurance policies are not contracts of indemnity. No money payment can indemnify for loss of life or for bodily injury to the insured, and that is why life insurance is an exception to the general rule. The principle of indemnity is closely related to insurable interest. The problem in insurable interest is to determine whether any loss is suffered by a person insured, whereas in indemnity the problem is to obtain a measure of that loss. In the basic fire insurance contract, the measure of actual cash loss is the current replacement cost of destroyed property less an allowance for estimated depreciation. In liability insurance, the final measure of loss is determined by reference to a court action concerning the amount of legal liability of the insured for negligence. In any event, the purpose served by the principle of indemnity is to place the insured in the same position as before the loss. One of the important results of the principle of indemnity is the typical inclusion in insurance contracts of clauses regarding other insurance. The purpose of such clauses is to prevent the insured from taking out duplicating policies with different insurers in the expectation of recovering more than the actual loss. Typically, such clauses provide that all policies covering the same risk will share pro rata in the loss. Thus, if Desta carries 4,000 BR fire insurance in Company A and 6,000 BR in Company B, the two insurers will divide a 1,000 BR fire loss 40% and 60%, respectively. Methods of providing indemnity. There are four basic methods of providing an indemnity. I. Cash. Many claims are settled by means of a cash payment to the insured. All that insurers require is reasonable proof of the cause and extent of the loss, and the cash payment is the measure of indemnity, or extent of the insurer's liability for any given loss. E. Repair. An adequate repair constitutes an indemnity. This form of settlement is particularly common in motor insurance, where the insurer settles the repair bill direct with the garage concerned. E. Replacement. It is sometimes advantageous for the insurer to replace an article rather than to pay cash. With a very new item or with such things as jewelry and furs, depreciation is likely to be negligible and the insured may well be content with a new replacement, which might possibly be acquired at a discount from the appropriate dealer. In glass insurance, it is the usual rule to replace, and all insurers pride themselves on the speed with which they replace shop windows so that there is minimum disturbance of trade. IV reinstatement. This is a term usually found in fire insurance and concerns the restoration or rebuilding of premises not necessarily on the same site to their former condition. Check your progress. 2.1. 1. Explain when an insurable interest exists. 2. Explain why insurable interest exists for creditors and debtors. 3. Contrast the problem of principles of insurable interest and indemnity. 2.4. Principle of subrogation. The principle of subrogation grows out of the principle of indemnity. Under the principle of subrogation, one who has indemnified another's loss is entitled to recovery from any liable third parties who are responsible. Thus, subrogation in insurance is the transfer by an insured to an insurer of any rights to proceed against a third party who has negligently caused the occurrence of an insured loss. For example, an automobile insurer that has paid a collision insurance claim obtains the right to collect reimbursement from any negligent third party who caused the accident. The insured who has been indemnified by the insurance company may neglect to prosecute the wrongdoer where liability exists, or he might prosecute in order to get double recovery. Double recovery would violate the indemnity principle. By subrogation, the dilemma is resolved by assigning to the insurance company the right to prosecute the action against the wrongdoer and thereby recoup a portion or all of the damages paid to the insured. Such salvage by insurance companies helps to maintain lower rate levels for insureds. Subrogation is a corollary of the principle of indemnity, and the right of subrogation, therefore, applies only to policies which are contracts of indemnity. Thus it does not apply to personal accident or life policies. For instance, if the death of a life insured should be caused by the negligence of a third party, his legal personal representatives may be able to recover damages in addition to the policy monies. The insurers have no right of action against the third party and cannot benefit by any damages received. 2.5. Principle of utmost good faith. Insurance is said to be a contract of utmost good faith. In effect, this principle imposes a higher standard of honesty on parties to an insurance agreement than is imposed in ordinary commercial contracts. Insurance contracts are based upon mutual trust and confidence between the insurer and the insured. Contracts of insurance are different because one party to the contract alone, the proposer, knows, or ought to know, all about the risk proposed for insurance, and the other party, the insurer, has to rely largely upon the information given by the proposer in his assessment of that risk. For this reason, insurance contracts are contracts of the utmost good faith. The application of this principle may best be explained in a discussion of representations, concealments, and warranties. Representations. A representation is a statement made by an applicant for insurance before the contract is effected. Although the representation need not be in writing, it is usually embodied in a written application. It is a statement in response to a question by the insurer. An example of representation in life insurance would be yes or no to a question as to whether or not the applicant had ever been treated for any physical condition by a doctor within the previous 5 years. If a representation is relied upon by the insurer in entering into the contract, and if it proves to be false at the time it is made or becomes false before the contract is made, there exists a legal ground for the insurer to avoid the contract. Avoiding the contract does not follow unless the misrepresentation is material to the risk. That is, if the truth had been known, the contract either would not have been issued at all or would have been issued on different terms. If the misrepresentation is inconsequential, its falsity will not affect the contract. However, a misrepresentation of a material fact makes the contract voidable at the option of the insurer. The insurer may decide to affirm the contract or to avoid it. Failure to cancel a contract after first learning about the falsity of a material misrepresentation may operate to defeat to insurers' rights to cancel at a later time, under the doctrines of waiver, voluntary relinquishment, of a known right or estoppels which prevents a person from asserting a right because he has acted previously in such a way as to deny any interest in that right. Concealments. Concealment is defined as silence when obligated to speak. Concealment has approximately the same legal effect as a misrepresentation of a material fact. It is the failure of an applicant to reveal a fact that is material to the risk. Because insurance is a contract of utmost good faith, it is not enough that the applicant answer truthfully all questions asked by the insurer before the contract is effected. The applicant must also volunteer material facts, even if disclosure of such facts might result in rejection of the application or the payment of a higher premium. The applicant is often in a position to know material facts about the risk that the insurer does not. To allow these facts to be concealed would be unfair to the insurer. After all, the insurer does not ask questions such as, "Is your building now on fire?" or, "Is your car now wrecked?" The important, often crucial, question about concealments lies in whether or not the applicant knew the fact withheld to be material. The tests of concealment are: 1. Did the insured know of a certain fact? 2. Was this fact material? And 3. Was the insurer ignorant of this fact? Warranties. A warranty is a clause in an insurance contract holding that before the insurer is liable, a certain fact, condition, or circumstance affecting the risk must exist. For example, a marine insurance contract may state, "warranted free of capture or seizure." This statement means that if the ship is involved in a war skirmish, the insurance is void. Or a bank may be insured on condition that a certain burglar alarm system be installed and maintained. Such a clause is condition precedent and acts as a warranty. A warranty creates a condition of the contract, and any breach of warranty, event if immaterial, will void the contract. This is the central distinction between a warranty and a representation. A misrepresentation does not void the insurance unless it is material to the risk, while under common law any breach of warranty, even if held to be minor, voids the contract. Warranties may be express or implied. Express warranties are those stated in the contract, while implied warranties are not found in the contract, but are assumed by the parties to the contract. Implied warranties are found in ocean marine insurance. For example, a shipper purchases insurance under the implied condition that the ship is seaworthy, that the voyage is legal, and that there shall be no deviation from the intended course. Unless these conditions have been waived by the insurer, legally cannot be waived, they are binding upon the shipper. A warranty may be promissory or affirmative. A promissory warranty describes a condition, fact, or circumstance to which the insured agrees to be held during the life of the contract. An affirmative warranty is one that must exist only at the time the contract is first put into effect. For example, an insured may warrant that a certain ship left port under convoy, affirmative warranty. And the insured may warrant that the ship will continue to sail under convoy, promissory warranty. Check your progress. 2.2. 1. Explain how the dilemma in principle of subrogation can be resolved. 2. What are the tests of concealment? 2.5. Principle of contribution. Contribution is the right of an insurer who has paid under a policy to call upon other insurers, equally or otherwise liable for the same loss, to contribute to the payment. Where there is over insurance because a loss is covered by policies effected with two or more insurers, the principle of indemnity still applies. In these circumstances, the insured will only be entitled to recover the full amount of his loss, and if one insurer has paid out in full, he will be entitled to nothing more. Like subrogation, contribution supports the principle of indemnity and applies only to contracts of indemnity. There is, therefore, no contribution in personal accident and life policies under which insurers contract to pay specific sums on the happening of certain events. Such policies are not contracts of indemnity, except to the extent that they may incorporate a benefit by way of indemnity, e.g., payment of medical expenses incurred, in which respect contribution would apply. It is important to understand the difference between contribution and subrogation. Subrogation is concerned with rights of recovery against third parties or elsewhere in respect of payment of an indemnity, and need not involve any other insurance, although it frequently does. Contribution necessarily involves more than one insurance, each covering the interest of the same insured. Basis of contribution. At the time of a claim, insurers usually inquire whether any other insurance exists covering the loss. Where other insurances do exist and each policy is subject to a valid claim, contribution will apply so that the respective insurers share the loss ratably. This term allows two constructions, both of which are found in insurance. Contribution according to independent liability. This means that the amount payable by each insurer is assessed as if the other insurances do not exist. If the aggregate of the amounts so calculated exceeds the loss, each insurer's contribution is scaled down proportionately, so that an indemnity is provided. This method is usually found where for some reason one or more of the policies will not cover the loss in full. This happens particularly in many fire policy contributions. Contribution according to the sums insured. This is the normal method of contribution. Insurers will pay proportionately to the cover they have provided, in accordance with the following formula. Sum insured with the particular insurer. X loss equals contribution. Total sums insured with all insurers. Example. Assume that Otto Kabid has insured his house, which is worth 80,000 Br against fire. Insurers X, Y, and Z for 60,000 Br, 40,000 Br, and 20,000 Br respectively. Otto Kabid's house was completely destroyed by a fire caused by Otto Alamu's negligence. The amount of indemnity that Otto Kabid will be entitled to receive would be 80,000 Br, the value of the actual loss or the amount of insurance carried. The amount that each insurer is entitled to contribute would be as follows. Bridge, 60,000. X's share of the loss X bridge. 80,000 equals bridge. 40,000. Bridge. 120,000. Bridge. 40,000. Y's share of the loss X bridge. 80,000 equals bridge. 26,667. Bridge. 120,000. Bridge. 20,000. Z's share of the loss X bridge. 80,000 equals bridge. 13,333. Bridge. 120,000. Total indemnity bridge. 80,000. Check your progress. 2.3. 1. Explain why the principle of contribution supports the principle of indemnity. 2. Differentiate between subrogation and contribution. 2.6. Essential requirements of an insurance contract. A contract is an agreement embodying a set of promises that are enforceable at law, or for breach of which the law provides a remedy. These promises must have been made under certain conditions before they can be enforced by law. In general, there are 4 such conditions, or requirements, that may be stated as follows. 1. The agreement must be for a legal purpose. It must not be against public policy or be otherwise illegal. For example, a contract of insurance that covers a risk promoting a business or venture prohibited by law is void. Similarly, a gambling contract will not be enforced by law. 2. The parties must have legal capacity to contract. This requirement excludes persons who have been deemed incapable of contracting, such as those who have been judicially declared insane, and persons who are legally incompetent, such as infants, drunken persons, etc. 3. There must be evidence of agreement of the parties to the promises. In general, this is shown by an offer by one party and acceptance of that offer by the other. 4. The promises must be supported by some consideration, which may take the form of money, or by some action by the parties that would not have been required had it not been for the agreement. 2.7. Events covered under insurance contracts. Most insurance contracts contain certain exclusions, such as for loss due to war, loss to property of an extremely fragile character, and loss due to the deliberate action of the named insured. Most property insurance contracts require the insured to notify the insurer of loss as soon as practicable, and usually require that the insured prove the loss. Named peril versus all risk. The named peril agreement, as the name suggests, lists the perils that are proposed to be covered. Perils not named are, of course, not covered. The other type, all risk, states that it is the insurer's intention to cover all risks of accidental loss to the described property except those perils specifically excluded. Excluded losses. Most insurance contracts contain provisions excluding certain types of losses, even though the policy may cover the peril that causes these losses. For example, the fire policy covers direct loss by fire, but excludes indirect loss by fire. Thus, the policy will not cover loss of fixed charges or profits resulting from the fact that fire has caused an interruption in business. Separate insurance is necessary for this protection. Excluded property. A contract of insurance may be written to cover certain perils and losses resulting from those perils, but it will be limited to certain types of property. For example, the fire policy excludes fire losses to money, deeds, bills, bullion, and manuscripts. Unless it is written to cover the contents, the fire policy on a building includes only integral parts of the building and excludes all contents. Defining the insured. All policies of insurance name at least one person who is to receive the benefit of the coverage provided. That person is referred to as the named insured. In life insurance, he is often called the policyholder. Third-party coverage. Many insurance contracts may provide coverage on individuals who are not direct parties to the contract. Such persons are known as third parties. In life insurance, the beneficiary is a third party and has the right to receive the death proceeds of the policy. The beneficiary can be changed at any time by the insured, unless this right has been formally given up, i.e., the insured has named the beneficiary irrevocably. The beneficiary's rights are thus contingent upon the death of the insured. Excluded locations. The policy may restrict its coverage to certain geographical locations. Relatively few property insurance contracts give complete worldwide protection. For example, automobile insurance may be limited to cover the auto while it is in Ethiopia. If the car is, say, in Kenya, coverage is suspended. Insurance contracts may be discharged by the lapse of time, failure to pay premiums, failure to renew the contract, or cancellation of the contract. Chapter Summary. The most important fundamental principles of insurance contracts are principles of insurable interest, principles of indemnity, principles of subrogation, principles of utmost good faith, principles of contribution, doctrine of proximate cause. An insurable interest may be applied on life, property, or potential liability. An insurable interest in life exists for a. Self-insurance, b. Husband and wife, c. Creditors and debtors, and d. Partners. Insurable interest in property may arise in the form of ownership, husband and wife, administrators, executors and trustees, billis, agents and mortgagers. The principle of indemnity states that a person may not collect more than the actual loss in the event of damage caused by an insured peril. Thus, while a person may have purchased coverage in excess of the value of the property, that person cannot make a profit by collecting more than the actual loss if the property is destroyed. Many insurance practices result from this important principle. Only contracts in property and liability insurance are subject to this principle. Life and most health insurance policies are not contracts of indemnity. No money payment can indemnify for loss of life or for bodily injury to the insured. The indemnity can be made in the form of cash, repair, replacement, or reinstatement. Under the principle of subrogation, one who has indemnified another's loss is entitled to recovery from any liable third parties who are responsible. Principle of utmost good faith imposes a higher standard of honesty on parties to an insurance agreement than is imposed in ordinary commercial contracts. Contribution is the right of an insurer who has paid under a policy to call upon other insurers equally or otherwise liable for the same loss to contribute to the payment. A contract is an agreement embodying a set of promises that are enforceable at law, or for breach of which the law provides a remedy. In general, there are 4 conditions, or requirements, for insurance contracts. These are a. The agreement must be for a legal purpose, b. The parties must have legal capacity to contract, c. There must be evidence of agreement of the parties to the promises, and d. The promises must be supported by some consideration. The events covered under insurance contracts can be stated as named peril versus all risk, excluded losses, excluded property. Defining the insured, third-party coverage.